everyone. Today, I will be presenting our research on the dynamic relationship between technology stocks and the S&P 500. We examined how fluctuations in the technology sector influence market indices, incorporating structural breaks to gain a deeper understanding of these complex interactions. Introduction. The stock market is integral to economic development, facilitating capital raising and providing investors with growth opportunities. Understanding long-term market trends is crucial for investors, economists, and policymakers. However, the relationship between stock market indices, particularly the S&P 500, and stock prices in the technology sector has not been extensively studied. This research fills that gap by examining the long-term relationship, considering the impact of structural breaks, significant shifts in the behavior of time series data that can influence market analysis accuracy. Methodology. The research uses the Gregory-Hanson co-integration test to identify long-term relationships, incorporating potential structural breaks. Daily stock price data from 10 major technology companies, e.g., Apple, Microsoft, Nvidia, were used to calculate a technology sector average, TSA. The S&P 500 index, SPX, represented the broader market. Additionally, an error correction model, ECM, was applied to assess both short-term and long-term relationships between the SPX and TSA. Findings. The study revealed that the technology sector has a significant long-term impact on the S&P 500. Short-term fluctuations in technology stocks also have an immediate effect on the market. The ECM results indicated that the technology sector drives market performance and vice versa. Key insights from the research include: long-term relationship. The Gregory-Hanson test identified a strong positive relationship between the technology sector and the S&P 500 in the long run, suggesting that technological innovations and trends directly influence market dynamics. Structural breaks. The presence of structural breaks, which were detected using the Gregory-Hanson co-integration test, indicates that major economic events, policy changes, or market shifts can alter long-term relationships between stock market indices and technology stocks. Ignoring these breaks can lead to inaccurate market analyses. Error correction. The ECM showed that deviations from the long-term equilibrium between the S&P 500 and the TSA are slowly corrected over time, implying that market adjustments occur gradually after short-term shocks. Policy implications. Given the influence of the technology sector on the broader market, policies supporting technological innovation could enhance economic growth. Policymakers should focus on fostering an environment conducive to technological advancements, including research and development investments, tax incentives, and support for startups. Future research. Further studies could examine other sectors like healthcare or energy to identify similar long-term relationships. Employing advanced econometric techniques, such as threshold autoregressive models, could provide deeper insights into market dynamics influenced by different types of structural breaks.